everybody. I'm Rusty Tweed. I'm the president of TFS Properties. As you're well aware, we're in a catastrophe right now. It's a major pandemic now all over the world having to do with the coronavirus. And I think it's prudent that we all talk about the effects that are being created by it, the changes in the economy, and the changes in the real estate market. So today is actually the first of a four-part series, and we're going to be talking today about interest rates and cap rates. The second one, we're going to be doing a deep dive into the tax changes and advantages that you can take from that. The third one, we're going to be talking about Texas in particular. We've got some great footage of us. We were just there a month ago. And then the fourth one, we're going to be talking about triple net lease properties and diversifying your portfolio. So a little background. Again, I'm Rusty Tweed. I'm the owner of TFS Properties. We've actually been in this office now for 20 years, and these are the brokers that I have working for me. We have a very large database of investors, and so if you ever wanted to list a property with us, we have a great exposure for you. So if that's your case, let us know. We also have a lot of properties that we can help you with for doing a 1031 exchange. Okay, so our services, we really focus on income property. I know we're showing here 8 to 12% cap rates. That's actually pretty normal for a lot of the stuff we do. We're managing to find cap rates that are much higher than normal. But again, our big focus is on income property that have higher than normal cash flow. We do a lot of 1031 exchanges. I did my first exchange not quite 20 years ago. Since then, that part of my business has grown and grown and grown. And today I would say approximately 70% of all our transactions that go through this office are some form of 1031 exchange. We do a lot of commercial properties, triple net lease properties, some multifamily as well. A lot of the properties, I would say probably about 70% of all the transactions we do are actually off market. We have access to portfolios of properties around the country. I also belong to a network of brokers, and we meet every 2 months. At least we used to meet every 2 months. We'll see what happens going forward. But we would compare notes and go over what's happening in these different markets. And I would literally be in a different city like Charlotte, North Carolina, or Austin, Texas, or whatever, every 2 months. We have a really good overview of what's happening around the country. Also, we offer investing through IRAs. A lot of people don't realize it, but you can actually invest in real estate through an IRA. So we have several custodians we work with that are available for you. Okay, so again, as we know, this nasty little virus somehow came out of Wuhan, China, and has spread itself all over the world and created havoc all over. And it's not just health risks that we have, we also have economic risks. Literally weeks ago, we had one of the best unemployment records ever. I mean, we hit something like 200,000 people on unemployment, and suddenly that skyrocketed within 2 weeks to 3.2 million people. Unheard of. That's never happened that quickly and that dramatically before. So this is a big shock we're going through right now. All right, so what you're looking at here is a chart going back 100 years on the S&P 500. And what I want to show you here is each one of these vertical gray lines is a recession. So we've been through recessions before, and we're going to go through recessions again. What I really want to point out, though, is if you look, you can see, there's a bit of a pattern, but we average recessions about every 7 years, okay? And one of the longer periods was here, 1990 to 2000. That was 10 years. But the last round we had here, from 2008 to the current date, it's been 12 years. We've actually way overdue for a recession. What we don't know is the trigger event that causes the recession. And so this happens, let's put it this way. Every single recession we've had, it's been a different trigger event. We don't know what it's going to be. I mean, we've had many, many crashes in the past. There's the tech bubble burst, there's 9/11, all these different things. And again, you're in the middle of having a really good economy, everything seems great, and then boom, right out of nowhere, something hits us, and it's a trigger event, and we have a big crash. And again, it has happened over and over and over. Unfortunately, this particular trigger event has some serious health risks, and that's very unfortunate. But again, we've been through this before, and we'll get through it, and things will actually be really good again when we get through it, and hopefully there'll be a lot of changes that are for the good. But again, we really have to take a look at how we're going to get through it. Now, a lot of the people I'm dealing with, they obviously own rental properties. A lot of them have more than one property. They've had these properties for many years. They've used up a lot of the depreciation, etc. Also, these same people have retirement accounts. Now, when you look at the big picture here, interest rates were already ridiculously low, and they just went down some more. And because interest rates being down so low, it's really hard for people that want to get income off their investments to find something that makes sense. And this is, a big problem across the board with bonds, dividends, and real estate, and CDs. So again, as an investor, a lot of people are struggling. Where do I put my money to get, some half-decent cash flow? Well, I'm showing you here something that you know already. Interest rates are all-time low. I've been doing this for over 20 years. I remember doing seminars 20 years ago, and if I talked about anything less than 6 or 8%, people were bored. They just had no interest. Today, look at these rates. Today, if I talk about anything over 2 or 3%, people are actually pretty excited. And think about this for a minute. Back then, if I would have stood up in front of you folks and said, guys, you're going to have trouble finding CDs paying more than 1%, what would you have thought? That's right. You probably would have thought I was crazy back then. We never could have imagined rates going down this low. And what's really interesting is I think they're going to go lower, believe it or not. And so this is bad for people that need income. It's fantastic if you want to get a mortgage, but the truth is, for most people, the income part of it is very important, and it's really hard to find that. So 10-year treasury rates, as you can see, they've been going down, down, down for the last 40 years. All the way down to 0.84%, which is, again, ridiculously low. And again, a lot of people have money in bonds and these kind of things where they're expecting income off of it, and that income just keeps getting smaller and smaller and smaller. This was actually 1.5% a matter of weeks ago, and then with this new disaster that's occurred, it dropped down more. And believe it or not, I think it's going to go down even more, because we're really at the beginning of this whole cycle of what's going on. And we really don't know how long this is going to play out. How long is it going to take this virus to run its course, etc.? We don't know. It may be 4 to 6 weeks, but who knows? It may be longer. We pray that it's shorter than longer, but it's going to be a real big impact while that's occurring. And again, to offset that impact, they're going to lower rates some more. I'll pretty much guarantee it. And there's another reason why I think they're going to lower those interest rates, and I'm going to show you. So I like taking 10-year rates from all the different industrialized world countries. So here's China, and if you were to buy a 10-year bond from China, and these are numbers just from this past week, you would get a rate of 2.7%. If you bought a 10-year bond from Greece, 2.4%, Italy, 1.5%, and like I said, America was right in here at 1.5% just weeks ago, and then we've lowered it. Hong Kong, 0.9%. Canada, where I'm from, 0.9%. US, again, you got it around there. Taiwan, 0.5%. But you see a pattern here, folks. 0.5% for the UK, just over 0 for France. Japan is pretty much 0. Switzerland, a third, or negative a third, and Germany is about a negative a third. So again, we're sitting here in America thinking that our rates are super low, and they've gone even lower than we had them before. But the truth is, our rates are actually high compared to a lot of the rest of the world. And so by lowering our rates that we just did in the last few weeks, we're closer to the rest of the world, but we're still high compared to Europe and these other countries like Japan. And which really leads them to believe that because they're so low, we're going to be going lower. And again, we're just at the beginning of this whole cycle, so there's a good chance they're going to lower rates even more to try and help us get out of it quickly. Okay, so when you're looking at real estate, you really got to look at it long term. And so a couple rules I have. Number one, in order to be in real estate long term, you have to have staying power. And again, if you look at any chart going back as long as you want, with real estate, you're going to find that there's some dips, right? We're going to have some dips along the way in property values, but we always recover, always. Always, always, always. So the key is you got to stay in that market and come out the other end. Otherwise, you're going to lose money in your property, okay? So how do you keep that property and have that staying power? Well, you do it by having very good cash flowing assets. You want to have good tenants that can pay that rent no matter what's happening in the economy. Now, you may have to lower your rent, you may have to do some adjustments, but in the end, you got to keep that cash flow positive or you're going to run into trouble. And again, anything I've been involved in the past, that's what happened. You lost your tenant and you couldn't stay in the game. Okay, which leads me to rule number 3, your debt must be manageable, okay? I'm a big advocate of keeping the debt low or even zero. I own properties right now that I all paid off in cash. And if you have a property all paid off in cash, what's the worst thing that can happen? You go without rent if you lose a tenant, or you lower your rent. But again, it's very rare that you go negative cash flow on a property that you own outright. Now, if you are going to have net debt, you want to make sure that it's reasonable. 50%, maybe 60%. But I would only do that on a property I felt very confident could maintain itself through a recession. Also, if you don't have a tenant that you're totally confident in, you got to have reserves and you got to have the wherewithal to fix things if you lose that tenant or if there's a problem. So again, you have to have staying power or you're going to be upside down real quick. Now, one thing that's good about what's happening today as far as the government's reaction to it is we're seeing program after program after program being rolled out to save the day. And so as we know, just a few days ago, the $2.2 trillion package was announced and signed off by Trump. And so that'll be implemented, and it's being implemented as we speak now. And it wouldn't surprise me if there's some more programs coming out later. But in the end, the government is really just pouring the coals on big time to do everything they can to make, to give us basically a safety net on what's happening. Okay, so let's take a look at what I think or at least some possibilities are going forward. So like I just mentioned, there's a ton of government programs going into play here that are really going to give some kind of a safety net for a lot of these people that need to have their rent paid for them because they've lost their jobs and they're out of work, and it's a very sad situation. But like I said, we've got a ton of money coming into the system. Now, on top of that, what you're looking at here is debt on properties, mortgages. So over here in the first chart, this red line is the amount of loan to value on new properties being purchased at the time. And so if you look back here to 2008 and 9, which was kind of the heyday when we had all the subprime loans and everything, you can see that the average new property was purchased with about a 70% loan to value. Now, I know we've heard all these stories. You probably watched The Big Short, and they've talked about how the loan to value back then on the subprime loans was like 98% or sometimes even over 100%, which is ridiculous. But only about 20% of the loans that were underwritten back then were in the bracket, were that high. When you average out all the loans at the time that were being generated, it was around 70%. Now, that's high. If you look back here, much, much lower. Back here, it was more like 50% or 60, yeah, it's about 50% back there. And that goes back, 20 years or so. So you can see that the loan to value jumped up quite a bit. Also, this green is the average of all properties in the entire United States. So again, if you took all the properties in the United States and took all the mortgages, it averaged out to about 50%, which again was very high. Back here, it was about 30%. So it went up quite a bit over a 20-year period. And so when we went into the subprime mess and the whole 2008 crash, the debt on properties was unusually high, way higher than normal. And so when you have a lot of debt on a property, obviously your mortgage payment is higher, you have very little equity in the property, and you just don't have the staying power that you would in a low debt property. So again, you look here going forward, and here we are currently, the average property being purchased today is less than 60% loan to value. It's closer to 50%. That's really good. That means there's a lot of properties being purchased with no debt. And again, people who are buying properties are putting very large down payments. They have a lot of skin in the game, and they've got a lot of room in that equity. If that property went down, they still have equity in it. Like again, if you're buying a property with 50% down, property can go down 25% and you still have some equity there, and you're not going to walk away from that property. Also, again, when you look at the average of properties across America, you take all the property values and divide it by how much debt there is on it. And look at this. It's down to about a third, less than 40%. And so that's really good. That means the debt load on properties across America, again, on the average, is very low. That's very good. Okay, so this here chart, the second one, is telling us the proportion of a person's pay or their income that's going to pay their mortgage. So again, traditionally, it was very low over here. It went up, 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 and then again, back in 2008 or 9, a very large portion of a person's paycheck was going towards their mortgage payment. Too high, in fact. And you can see the good news here, though, is that when the things progressed today, it's actually one of the lowest ever people's paycheck going towards their mortgage payment. That's very good because, again, when a large part of your paycheck is going to your mortgage payment and things get bad, your wife loses her job, you only have one income when you used to have two, or you had to take a pay cut or whatever happens, when you've got a huge part of your paycheck going to your mortgage, that's tough, really tough. And that's exactly what happened. A combination of these two things, there was many, many foreclosures, vast amount. But today, it's very low. And so again, people have some wiggle room, and banks have been much more careful underwriting loans as well. So if one spouse lost their job and the other one's still working, they could probably keep making their mortgage payment. And then you combine that with the tax break or not the tax break, but the mortgage break that's being given by most banks right now. I was just talking to somebody the other day, and they said, yeah, I called up my bank, and right over the phone, they gave me a 90-day holiday on making my mortgage payments, like right over the phone. We didn't have to do any paperwork or anything. So that's good. And now it doesn't mean you get out of paying that part of your mortgage. They just push the mortgage back, so you're going to have 3 extra months at the tail end of payments. But that's good. If banks can afford to do it or whatever, it's good for everybody. As long as this whole situation we go through only lasts 90 days. If it goes past that, they're going to have to do it again. But again, why I don't think we're going to see any big crash in real estate, we'll see a softening, no question about that, is because of this. The debt load and the income ratio is actually in very good shape compared to normal, one of the best ever. And going forward, I mean, there's going to be winners and losers. You know, if you're a landlord and you've got some large restaurant in your property, that's not a good situation. And who knows how long it takes before people start going back to restaurants, even when we do get back to normal. So yeah, there's going to be some properties and some situations which are not good. But there's going to be a lot that are going to be totally fine and come out of this without a big problem. So again, let's cross our fingers and hope that this is going to be short, that the virus cycle is very quick and we get through it quickly, because obviously the quicker the better. Now, here we're showing you long-term prices of homes. This goes back, I believe, this is about 60 years. And the point here is that we've gone through some other recessions. Here's the one in 2008. We had a big drop, but then it came back. And so real estate always makes a comeback. Unless you're in some crazy little town, you know, it could be a little mining town in West Virginia, mine gets shut down and there's literally no more work anywhere for there. That may be a long-term situation. But the vast majority of major metropolises in America, they go down, they come back up, you know, there's these cycles. But you always come out the other end. Now, what did we do back then? Well, when things dropped, we all heard the term too big to fail, right? And a lot of money got dumped in through what they called quantitative easing, and that was the first one. Things still didn't recover. They did quantitative easing 2. And then things were still not recovering like they wanted. So now we had quantitative easing 3. And then we see things turning around. And this is a vast amount of money. I mean, there's $1.7 trillion up front here, another $600 billion here, and then this program, they were dumping in $40 billion a month for several years, like 3 years. That's a huge amount of money. I mean, we're talking about somewhere between $3 and $4 trillion that got dumped into the system. Now, what happened after that? Well, take a look. Boom, prices shot up. And again, if you're here in California, in Los Angeles area, you could pick almost any property in LA, and if you would have bought it somewhere around here, you know, 2009, 10 or something like that, that property is doubled in value. And there's actually neighborhoods, for example, Venice Beach and Silver Lake and stuff, where it's actually gone up 2.5 to 3 times the value in that time period. So The point I'm making is all these programs of the government dumping money into the system percolate through the system, and eventually, boom, it comes out the other end and you get prices going up. And the same thing with the stock market. Whoops. In the stock market, you can see here, that was when we had the crash in 2008. Quantitative easing went in here, and you can see the stock market just went up and up and up because that $4 trillion went somewhere, right? So that's something to look at because, again, they've got a bunch of these programs going in now, and they can continue to do that. I think they're going to keep doing it until the market really does turn around, the economy turns around, and real estate turns around. So, yeah, we'll see how all this plays out, but that's what's happened in the past. So as an investor, where are the opportunities? Well, interest rates, like I said before, are ridiculously low, and they're going to go down even more. I really think that. So when interest rates are really low, a lot of money is going to go looking for a home that has some kind of return, right? We call it chasing yields. And so we're going to see a bunch of money that used to be in the stock market is going to go into bonds, but then the bonds are so low and they're going to be looking for higher returns. We have a lot of these government programs, like I said, pushing money into the system. There's also a lot of programs that are helping renters, right? There's actually some great programs that FEMA and some other organizations, HUD does, that covers people's rents through disaster periods, and those are kicking in too. So again, rental properties make a lot of sense. You're going to get a much better cap rate, much better cash flow on rental property than just about any other investment right now. And again, because of the stock market going through what it is, a lot of people, especially people that are retired, and go, look, I'm really backing off in the stock market. I need to put my money somewhere else. So even though we're going through all these problems, I really think that we're still going to see an inflow of money into real estate once people start feeling a little more comfortable, and rental properties is definitely going to be attractive. And again, everybody's looking for cash flow. Cash flow, cash flow, cash flow. That's where it's at. Okay, so now let's talk about cap rates. So a cap rate is the measurement we give to an income property, okay? And so not everybody looks at it this way. We do, but especially in the commercial real estate market, it's really a very clean-cut mathematical way of looking at a property. Okay, so the term cap rate is really short for capitalization rate. And the capitalization rate is a way of measuring the income off the property, and it's the net operating income. Okay, so it's the income after all the expenses. So that net income divided by the fair market value of that property gives you the cap rate. So let's look at that a little closer. Net income means we take our gross income, whatever it is, $10,000 a month, $5,000 a month, and we subtract our expenses. What expenses are we going to deduct? All of them except for the mortgage payment. We do not include the mortgage payment as part of this because everybody's going to be different, right? I may buy property all cash. Someone might buy it for 70% loan to value. I don't have mortgage payment. They do. And so that changes the calculation. Cap rate is apples to apples. You just look at the property, and whatever the owner did with the debt part of it is up to him, but we can compare that property very clearly between each other without the debt. Okay, so what are the expenses? Well, obviously there's property taxes. We have to take those away. We've got insurance, and it depends. You might have flood insurance. You might have some other property casualty type insurances. Management expenses, if you have a property manager running that property for you, you got to deduct that as well. Maintenance, a lot of people, when we sit down, we try to figure out what their income is, net income off a property. They don't put in all the expense stuff that they spend on the maintenance. And so there's a lot of nickel and diming, and whenever you lose a tenant, you've got to fix things up or whatever. All that gets added in there, and we have to average that over the last several years to see what that number is. Any other expenses, there can be landscaping that you're doing. You have to bring in your, well, again, it depends on the property. Some people, the landlord pays the utilities, for example, the water and the electricity, etc. Some properties, the landlord doesn't pay those. But again, whatever expenses you have to factor those in. And vacancy factor. I mean, it's pretty rare property that never has a vacancy, right? And so you have to factor that in. If you have a 10-unit apartment building, every year, a couple of years, you're going to lose a tenant. You have to go in there and fix the unit up, clean the carpets, fix up the paint job or whatever. And then there's going to be some downtime while you get a new tenant in there, and that downtime could be 6 weeks or whatever while you go through all the motions of cleaning up the unit and then advertising for another tenant. And in a good economy, you get tenants right away. In a bad, slow economy, you might wait several months to get a new tenant. But again, that needs to be factored in because that's going to be expense. That's going to lower your income. So let's go through an example here. Let's just say we had an apartment building with $60,000 of net income, and the property value was worth $1.5 million. You divide that out, boom, 4% cap rate, okay? Now, this is a way of looking at a property like a bond. You went and bought a bond for $1 million, and it pays 4%. So you know right away that $1 million bond is going to pay you $40,000. And again, this is just a way of apples to apples and seeing what the cash flow is in the property. You can also look at it backwards too. For example, the area that we're in here in the San Gabriel Valley, the average cap rate for multifamily is about 3%, okay? So we can plug that 3% into the formula. We can sit down with somebody and find out what their net operating income by getting them to bring in their rent roll and their expenses and everything. And we can calculate backwards and find out what the value of that property is, okay? And also we can look at it from the point of view of different markets. Different markets will have different cap rates. Well, I'll show you again in the next couple of slides. All right, so let's just run through the numbers. Here's a typical property here in LA anyway. 10-unit property. Let's just say it's got $1,000 a month of rent. So you take that $1,000 a month times 10 units times 12 months. Boom, we get $120,000 of gross income. Then we take away all the expenses. In this case, it's about $60,000, and that gives us a net income of $60,000. Now, in this market, where we're using a 4% cap rate because that's average more for LA, and we do the math on that, and we come up with our value, $1.5 million for the building. Now, if you're going to increase the value of that building, and you know that the average cap rates in the area is 4%, what do you have to do? You have to increase the net operating income. If you can't increase the net operating income, you're kind of stuck. I can't see how that property is going to go up. Properties don't magically go up on their own when it's rental properties. Now, I bought a property many years ago when I was literally 21, and I paid $84,000 for that rental property. This was in Toronto when I first moved to the big city, and I managed to scrape enough money together to actually buy a triplex. Well, that property over the next 7 or 8 years went up to $280,000. Now, I did a little work on it. I fixed up the kitchen somewhat, but believe me, I did not spend $200,000 on it. That property just magically went up on its own. And in some markets, that happens, okay? But really, it was luck. I didn't know it was going to go up that much. I had no idea, actually. But when you're talking about income property like this, it's really based on the rents. So the only way you're going to raise the value of this building is by somehow raising your rents. So you really have to take a good look at what the opportunities are to raise the rent. If you buy a property and the rent is below market, then as one tenant moves out, you can renew the lease and get a higher rent. And that's going to increase the value of that building. Now, we just went through an amazing run in the economy, and rents were going up. I mean, I can't believe what people are paying for rent all over the place. They've gone up dramatically. And that's dramatically increased the value of income property. But what happens when income drops and people can't afford those high rents? Well, you may have to lower the rent of your property. If you have to lower your rent of the property and you're now getting $50,000 of net income and the cap rates are around 4% in the market, what did you do? You just lowered the value of that building. So that can happen. And again, the last 7, 8, 9 years, really the last 12 years, we've had just this upward curve, and people forget. I mean, I've been through this. I've been working with clients who had a 4-unit building and 3 of their tenants left. And so they were stuck with negative cash flow for a while until they got new tenants. And then when the economy's bad, they have trouble finding new tenants. And it could be months finding a new tenant. And you have trouble finding a good quality tenant because a lot of the people you're getting coming in applying, they've had some financial difficulties, which happens in a bad economy. So apartments tend to be your best appreciating type property when you can raise the rents and the economy's doing good. Unfortunately, they're one of your worst depreciating assets when you're in a bad economy and you're losing tenants. So you need to be aware of that. Now, there is a relationship between cap rates and interest rates. And I'm talking about this because, like I said, interest rates have gone down, pretty dramatically over the last, really, they've been dropping for 40 years. But they've dropped even more recently. So here's going back the last 20 years, and you can see this black line is Treasury rates. Back here in the year 2000, Treasury rates were about 5%, okay? And if you look at the blue line here, that's the cap rates on multifamily properties across the United States. Here in LA, it would be lower, but other markets, it'll be higher. So when you average it all out, back in the year 2000, it was 8.5% cap rate. So again, you could buy $1 million property back then, and all day long, you could have gotten an 8.5% cap rate, which would have been $85,000 of net income that you can go spend. As you can see, rates kind of bumped around and went down. As they went down, cap rates went down. Here, which was in 2008, when we had the market crash, cap rates went up. Actually, interest rates went down, but cap rates started going down too, because again, as interest rates go down, cap rates will go down as well. Now, why do cap rates go down when interest rates go down? Well, let's just say I had $500,000 in the bank, and I'm sitting here thinking, okay, back in 2000, I just have to put my money into a CD or some kind of low-risk bond, like a U.S. Treasury bond, and I would get 5%. And I do nothing. I've got no toilets to worry about. I got no phone calls from tenants. I don't have to go on the weekend and, fix some plumbing. I mean, there's just nothing. I just sit at home, watch TV, and I get my 5%. So why would I want to put my money into an apartment building? Well, that apartment building has to pay me more than 5%. I'm just not going to be interested in doing it. And that's exactly what happens. So there's always this spread between a low-risk, passive type investment like a treasury bond and something that's like an apartment building that's a little more, there's more risk involved. And so here you got a spread. So if I was willing to put in the extra work and buy a building and go through all the motions of maintaining it, then I'm going to be rewarded by getting 8.5%. So as interest rates go down, cap rates go down as well, because, and right now, before this was at the end of the year, before the rates dropped even more. So back here, rates were about here it was about 1% when we did this. And so back then, and again, this was just 2-3 months ago, multifamily properties average across America was 6% cap rate. Much, much lower in LA here, but around the country is more like 6. So again, I could put my money into a bond and get 1%, or I could put my money into a building and get 6%. And it's all a risk-reward ratio. So as interest rates go down, I'm more willing to put my money into the apartment building that has a much higher cap rate than the interest rate I'm getting on a CD or a bond. And I see it all the time. It's exactly what happened, especially back in 2000, in that range, when rates started to really drop. There was people that would come into my house and say, look, I got this CD, I was getting 6%, it just matured, and I'm only going to get 2%. I can't do that. I got to make more than that. So let's buy a building. And it happened all the time. So a lot of money goes into real estate when interest rates are low, not because of the mortgages. I mean, mortgages is a factor, but as we showed you before, there's a lot of properties being bought with low or no debt. And so a lot of the money that's going in, I think, and for what I see with people we're dealing with, it's really money that they'd rather put into real estate because the return is better than going into other types of things like CDs or bonds or even dividends from stocks, because they got to have the income. And right now there's something like 80 million people in America, which is a big amount of people, that are retired. And all those people need income. And then on top of that, there's a lot of investors we work with that they're just concerned they want to have some good cash flow off their investments. They don't want to wait 5 years to get a return. So again, rental properties is looking very attractive. And now rates have kind of fallen off the cliff. And like I said, it's down now here to less than 1%. If I was going to bet money, we may see rates go down to 1/4%, believe it or not. It wouldn't surprise me at all. Either way, less than 1% is very low. So if you had $1 million in the bank, right, and you're retired and you put it in a CD, you're only getting $8,500 right now. I mean, it's unbelievable. So you need to have a lot of money in the bank to be able to get any kind of return on it that you could live off of. So again, it's forcing people and forcing pension funds, it's forcing insurance companies and everybody else to really take a hard look at where they can put their money and get more than 1%. And that's not going to go away. We need income. Like I said, a lot of these big pension funds, they have hundreds and hundreds, if not trillions of dollars that they have to deploy that has to get some half-decent income, or they're not going to be able to meet their projections for the pensioners that are drawing from it. And that's for real. And especially with the stock market going down like it is, it's changing the game quite a bit. They have to look at alternatives. So I really think that rental properties are going to continue to be attractive. Now, we're going to have a pause here. We're going to have people kind of worried about what's happening and see how it plays itself out, et cetera. But I think the long-term projections are that we're going to have to be buying rental property because there aren't a lot of alternatives to put your money in to get some kind of stable cash flow. And in the end, people have to live somewhere, and you have to have businesses somewhere. And so, you know, the rates may change or whatever, but in the end, we're going to get a better rate of return and better cash flow in our rental property than we're going to get in other forms of investments. Plus, there's all the tax advantages, which I'm not going to be going into today, and Tony Watson will be talking about that quite a bit in our next seminar that we're doing in a couple days. But the main thing here is that you get a lot of tax advantages in real estate that you don't get in bonds and other things. And so that makes it very attractive. Okay, so looking at the big picture here of cap rates, what you're looking at is obviously a map of America. And I apologize, the colors didn't come through really good on our screen, but there's this is showing the difference in cap rates in different markets. So if you're in the West Coast, for example, the cap rates here are very low. They're like 3 or 4%. They're the darker green. And you can see New York, for example, it's very low. Truthfully, the Midwest tends to have much, much higher cap rates. And so let me show you how this works. Here's a Starbucks. This was an actual sale a couple of years ago down in Orange County in Costa Mesa. And this Starbucks was sold at a 3 3/4% cap rate. We take the same Starbucks, only this time it's in Kansas. And that's sold at a 5% cap rate. Again, we take a Starbucks, only this time we buy it down in Florida, and this comes at a 5.5% cap rate. Again, another Starbucks, only this time it's in Indianapolis, and for whatever reason, out of all the major markets, the top 15 markets in America, Indiana and Indianapolis always comes out at the top cap rate. And in this case, it was 6.5%. Now that was a few years ago. Since rates have gone down since then, you're probably not going to find one at 6.5. It's probably going to be maybe 1% lower now because rates have gone lower, which have made 6.5% on a Starbucks more attractive. But you get the picture here. Same Starbucks, same lease, only different markets, and you can see there's a big difference in cap rates. And again, we can argue why that happens or how that happens, but in the end, different markets and different types of assets will give different cap rates, and also in the end, it has to do with risk level as well. It has to do with the local market, and it has also to do with the risk level. So a triple net long-term lease on something like Starbucks will have a lower cap rate than multifamily, because multifamily, everybody knows you can lose tenants. So those cap rates tend to be a little higher because there's more risk you're taking owning an apartment building. All right, now, again, we deal with a lot of people here in LA that have had huge appreciation in their property, but their income isn't that great because the cap rates are really low. So when we show them the difference here, you can take that money and go into a different market and get a much, much higher cash flow. And on the fourth part of our series, we're going to be going through actual examples that we've done with clients and go through portfolios we built for them where they went from getting 3 or 4% cap rate here at best, and we put them in a portfolio of properties in other parts of the country that we feel very strongly about, and now they're getting 8%, 9% cash flow. I mean, literally doubling or tripling their income, and we do that routinely. Okay, so what you're looking at here is affordability index. So believe it or not, Los Angeles, California is now the most expensive city in America to live in based on the average income, okay? And so that's what you're seeing here, this red line. We're above New York. Now you're probably thinking, wait a minute. I have friends in New York, and I can't believe what they pay for rent. I mean, it's ridiculous. But guess what? if you're living in New York, you're probably working in Wall Street or some high-end company, and you're making way more than you would be if you're working the average job here in LA. And so, again, we take the average income, compare it to the rents here, and the rents are very, very high here, very high. And the same thing with the Bay Area. You know, there's people up there I know, and they have very high rent too. But again, all those guys are working for high-tech companies, or at least they used to, and and you know, their rents are high, but they have very, very high salaries as well. So that leads me to say that if you're buying a property in LA, how much higher can that property go? And again, if you're buying a property and it's a rental property, the only way I can see that value going up is if you can increase rents. So if you're already the most expensive city in the country to live in based on the income here, how much higher can you raise your rents? I don't know. Unfortunately, we have this situation now with the coronavirus and the lockdown and people being laid off, etc., and that's going to make it a big problem. There's no way you're raising your rents now. And it may be a while before you can raise your rents. So it may be a while you can even collect rents from some people. So it's a problem. So again, I would not be excited about owning a property here for appreciation right now. And again, time will tell how it goes, but we'll see. The good news, though, is that the rest of the country doesn't have rent control. LA and California is the outlier, okay? So what you're looking at here is these orange states, which are Oregon, California, New York, and what do you have here? New Jersey, I believe. They're the only states that have rent control. The rest of the country, there's no restrictions on rent. You know, you get whatever the market is. And so when you look at it from that viewpoint, there's a lot of places we can go where we don't have to worry about, you know, having rent control and the other problems we're running into here in California and LA. Okay, so here's a property that we purchased for a client literally a matter of months ago, and it's an In-N-Out Burger, which everybody loves here in LA and California. This property was right on the 10 freeway, just out of LA. Had a 20-year triple net lease. Now, the cap rate here was 4.2%. And that was actually really good for LA, for an In-N-Out Burger. And again, it was brand new. So our client really wanted a nice trophy asset that they didn't have to worry about, that they didn't have any headaches, etc. And luckily we actually contacted the developer here and bought it directly from the builder who built it. So this was a great property. Now, why I'm bringing this up, you know, we're talking about what's happening with the economy and the coronavirus and everything else. Obviously, there's a lot of problems. There's a lot of restaurants shutting down. There's a lot of issues all over the place. But what do you think is happening with In-N-Out Burger? Because again, that cap rate is totally dependent on that tenant paying the rent. Well, there's an In-N-Out Burger just up the street from our office, literally blocks away. So I had the guys rent out just a couple days ago and tell me what was going on there. Well, they came back with this picture. So this is right in Huntington Drive, same street that my office is on. And you can see all these cars, looks like they're parked along the side of the road. They're not parked there, they're sitting there waiting in line to go through the drive-through. And literally, this was a couple days ago. Not only are they here, but it goes all the way around behind here on the next block. We literally have a 2-block lineup of cars waiting to go through the In-N-Out Burger drive-through. So, how much trouble is In-N-Out Burger going to have paying their rent? None. Not a problem whatsoever. That's the kind of tenant we want, especially in a recession. Now, we're not getting the highest return. We're only getting 4%. But when we look at that and compare it to CDs, and we compare it to the stock market, and we compare it to U.S. Treasury bonds, that 4% looks really attractive right now, very attractive. Also, my clients that are in this deal are not worried whatsoever about the economy. The economy can get a lot worse, and I guarantee you there's still going to be people buying In-N-Out Burger because they need to eat. And In-N-Out Burger is not very expensive, and they're really good. So we're not worried about a property like this at all. Another example, here's a Pizza Hut. Again, a 20-year lease. A client we did this with, they actually sold a building, a restaurant, actually in Alhambra a year ago, and they're probably really happy right now they sold it. And this one we bought in Maryland, and it was a 6% cap rate, again, brand new. Now, again, we're going through some hard times, and our client actually got a letter from Pizza Hut asking if they could have 3 months of rent abatement. Now, I heard about this and I was like, wait a minute, Pizza Hut? With all these people staying home, I can't imagine Pizza Hut's sales going down. And lo and behold, that same day, literally hours later, I turned on KTLA here in LA, and there was a news flash. Domino's Pizza is hiring 2,500 extra employees to handle the increase in business, right? So I had one of the guys in the office call up this particular Pizza Hut in Maryland and ask them how they're doing. And the guy that answered said, oh man, we've got more business than usual, for sure. So, do we need to give these guys rent abatement? No. We called our client up and said, you know what, that letter you got, just rip it up. There's no way. Pizza Hut is having no problem whatsoever making the rent payment. They're actually getting more pizzas sold today than they were 6 months ago. So they're just asking because everybody's asking, and I'm sure once in a while one of the landlords doesn't really think about it and says, yeah, sure, I'll give you the rent abatement. But there's no way we need to do that. Pizza Hut is doing absolutely fine. And again, when we're going through a market like this, that's what we want. Popeyes. So this is a property in Houston. We actually have it under contract right now. It's supposed to close in the next week. The client we have in it, they just sold a building over in the west side. Thank God the property went through. It was a big developer that really wanted their property for development. And yeah, the property went through in the middle of all this crisis. So that's a good thing. So we're about to close on this property we found for them in Houston. And you may not know Popeyes. I know there's some in LA, but in the Midwest, Popeyes is very popular. It's almost as good of a tenant as In-N-Out Burger. And so again, we're not worried. No matter what happens, somehow people are going to get enough money together to go eat and buy fried chicken or whatever they're going to buy. So again, this was a 15-year lease. Now again, this was a 5% cap rate. If that was here in LA, it would probably be a 4% cap rate. Now, I know a lot of people are hearing that deals are falling out of escrow and there's a bunch of problems with trying to close deals because everybody's panicking about what's happening. Our client is excited to buy this property because they know that getting a 5% cap rate on a 15-year lease on a property like that is great because there aren't really any good low-risk alternatives for them. And they're older and that's the kind of thing they want a no-hassle deal. And so we found this, bought it right from the developer, and yeah, good to go. And just to give you some comparisons, we showed that chart earlier, the cap rates of multifamily. We've done multifamily. Actually, Edward in my office gets credit for this. Him and his team were working feverishly to find a property for a client of ours in Houston, and they stumbled on this one. It was a 20-unit property, just outside of the main part of Houston, and it literally was only in the market for a day or two, and they stumbled on it. It happened to be an 8.5% cap rate. They jumped on it. They got an offer in it, got it accepted, and locked that one down. And truthfully, the seller actually realized later that they way undersold the property and tried to get out of the deal, but we already had a contract and they had to stick with it. So this was unusual to get a deal at the 8.5% cap rate, but just to show you the difference, multifamily will always be a little higher cap rate, or it should be anyway, than a triple net lease property. Yeah, and then at that time, okay, now this was not quite a year ago. At that time, we were seeing properties in the 7% cap rate. Since then, we have not seen any properties in that rate. I mean, in Houston, up until recently, we hardly saw anything more than a 5 or 6% cap rate. Property, and the whole multifamily market in America is like that. There's a lot of money chasing multifamily. I'm sure, like I said, there's going to be a pause in that because some of these tenants will end up not paying the rent and stuff, and we'll have some issues, and that will slow down the multifamily market. But in the end, I think it's going to be fine because people will get back to work and there will be government programs to help them pay their rent. And in the end, people have to live somewhere, right? And so multifamily long-term is going to be good because there is a shortage of housing across America right now. All right, some other ideas. Indianapolis, we've done well over 150 properties there. Now to talk about cap rates, so we do these small single-family homes, and like I say, we've done over 150 of them, and we have done other properties as well. We have done triple net leases and some industrial buildings. We do like Indianapolis a lot, but we've done particularly a lot of these. Now, you're going to buy, if you're interested, one of these small homes. They're all renovated, they've got a tenant in it, and they're all managed, and they average somewhere around $80,000, $90,000 a unit. And they pay an 8 to 9% cap rate. Now, Why are we picking Indianapolis? Well, one reason is it's a very, very stable market. Property values don't go up a lot there, but they don't go down a lot either. They're stable. And when we did our analysis and went back in time, and I apologize, we should have had a chart showing this, but when we went back in time, for example, 2008, 9, 10, property values dipped a little bit in Indianapolis, but they did not go down a lot. So again, it's not going to go up a lot, but it's not going to go down a lot. It's just a good, stable market, and we're getting much, much higher cap rates than we are in other markets, and especially better cap rates than in multifamily. So it makes a lot more sense to buy 10 units of single-family homes at an 8 or 9% cap rate than buying a 10-unit building that's paying a 5 or 6% cap rate. In my mind, everyone's going to have a little different thought on that. But as long as you have good management, I really think it's the same thing. You might as well buy the single-family ones, and you're going to have a much better cash flow. The other thing is, I would say 70% of the ones we sold were all cash. So when they're all cash, and you lose a tenant or have to lower your rent, not a whole lot happens. You're not going to go negative. And you can always rent a property if you're willing to lower your rent. Always. I know that for a fact. So if you buy something at an 8% cap rate, what's the worst thing that can happen here? You have to lower your rent, so now you're getting 6% or maybe 5%. All right? It's not the end of the world. And we all know that we will come out of this. Now, it may be several years, it may be 4 or 5 years. I don't know. We'll see. But when we come out of this, going into a property like this, your cash flow will go up and your value will go up. In the meantime, you still have some good positive cash flow. Okay, so Texas. Love Texas. We do a lot there. We've done well over 250 properties there. I got some properties there. Friends of mine have properties there. We've done stuff in Austin, Dallas, Fort Worth, and Houston, and a bunch of the outlying towns around Houston, Corpus Christi, Beaumont, all those markets. We've done a lot of properties. So Texas is just booming. And again, when we're talking about what's happening with coronavirus and all the economy, I know that the price of oil has bottomed out. I couldn't believe it went below $20 a barrel the other day. But in the end, it's going to come back. It always does. So we may go through a period when oil's really low and it's going to be tough on the oil companies, but you can't produce oil at $20 a barrel. You can't. They're going to run negative at that. So eventually it's going to go up. And again, there's a shock. Everybody's freaking out and the stock market crashes and everything else. But eventually we come through and get out of it. And again, especially with all these programs the government's pumping in, it's going to result in some big liquidity down the road. And it may take a couple of years for that to turn around, but it will. Not only that, it's so inexpensive to live and do business in Texas. You're seeing a huge migration of companies from California to Texas. And Texas has done a fantastic job with their infrastructure, with their energy costs, all that kind of stuff. So it's good there. So what we're doing there, we do these manufactured homes is one thing we do a lot of. Now, why do we do these manufactured homes? Well, a couple of reasons. One, their cap rate is very high. We're talking about 11 to 12% generally. And so that's a very high cash flow, right? Not only that, now when you think of these manufactured homes, these are nice parks. They're not, they're not real bad. They're not high end, but they're certainly not low end. So the people who live here, they're going to go through some issues with what's happening. But in the end, there's a lot of government assistance programs specifically for renters in that income bracket. And then on top of that, and we went back and did some studies from the last crash, these homes did fine. And another reason is that a lot of people downsize. So if you're having to pay $1,500 or $2,000 a month to live in a $200,000 home, and you can't afford that anymore because your wife lost her job or you lost your job, what do? Well, you're going to have to downsize. So these right now are about $1,000 a month rent. They're actually very nice. You're in a nice gated community, etc. And so it's not a bad place to land if you have to downsize. So we're doing a lot of these. And so traditionally, like I said, the rents haven't gone down. And we're about to see what happens as this rolls out. But so far, it's been no problem. And if you're interested, we're going to be doing a much more thorough talk on Texas in the third part, which will be in about 6 days. Another thing that we're doing in Texas is in Beaumont. We have access to a portfolio of single-family homes. These were through a bank, and they They actually went through foreclosure. They were rehabbed and put a tenant in and everything else. Now, why do we like Beaumont? Well, we got a great deal on these particular properties to start with. You can buy them with a tenant at around 8% cap rates. But more importantly is the job market in Beaumont, despite what is going on now, is booming. And the reason is, if you look at a map of Beaumont, it's right on the coast, and there's a pipeline coming in from the west of Texas, Permian Basin, and it lands right in Beaumont, and they've decided to make that a deep water port, so they're building that right now for giant super tankers to pick up the oil from the pipeline, and they're building 3 large oil refineries. That's a massive amount of work, and that's going to go, they figure, for 7 to 10 years, and that is not going to slow down for a long time. Despite the price of oil being low, we still need oil. Whatever price it is, we got to have oil for our cars. We have to have oil for agriculture, for making fertilizers. We have to have it for plastics, all this kind of stuff. So the use of oil, may slow down a little bit, but we got a long way to go before we replace it. And so we're going to need oil, and it's going to go through Beaumont. And so despite what's happening, we've checked it up in the last few weeks, and there's been no problems there whatsoever in the job market. We were there less than a month ago, and it was just ridiculous. All the hotels were overflowing. If you put a sign out front of an empty house like this right now for a renter, literally, the guy we're working with there, one property, he literally had 100 applications in a 24-hour period, literally. There's that much demand there right now. So with this economy the way it is right now, and again, we'll see how it plays out in the next few months, but we're not worried at all. This is a great market to be in. There may even be appreciation in this market the way the job market is there. All right, folks. So we're kind of at the end here now. We've gone through a lot of different subjects that we were planning on today, so that's it. If anybody has any questions, please type them in. You can do it right now if you want. And I will definitely get back to you, myself or my staff, in the next couple of days. If there's some really good questions in there, what we'll do is I will bring them up in the next seminar, and that we'll be doing in a couple of days. Now, in the meantime, if anybody wants a consultation, we do free consultations. You can call or email to us, and myself or my staff can do it. Now we can do it through FaceTime or Zoom or something. But yeah, especially if you're in a 1031 exchange, believe it or not, we're doing a lot of exchanges right now, and we will be for a little while because we have a lot of properties that are under contract and in the process of being sold or purchased. And so we're actually very busy despite what's happening with this economy. But we have a very good network and a very good portfolio available for people that are in an exchange and would like to pick from some of those properties. So yeah, feel free to give us a call, and we'll definitely do some scenarios for you. Now, like I mentioned earlier, today was part 1. Hopefully you got some good information out of this and was worthwhile. We have a lot more for you. As you know, the CARES Act just passed on Friday, and it's literally 800 pages, and it's chock full of all kinds of stuff, but there's a lot of tax breaks in there, a lot, unusual a lot actually. And so we're having Tony Watson talk on Thursday, and he's going to be walking us through all the ins and outs of all the taxes that are appropriate, or the tax breaks that are appropriate for our kind of clients. If you know anything about Robert Hall & Associates, they specialize in real estate investors and doing tax returns for them. And they're a very large firm right over here in Glendale. We've worked with them actually for many years, and they're perfect for the kind of clients we deal with because, again, they focus on real estate investors. Aside from that, we're going to have 2 more. Like I said, today was part 1, Tony's part 2. Part 3 will be on Saturday, and there we'll be talking about Texas, and we got some great footage of our trip that we did there just last month. And then part 4, we're going to have Edward up here, and he's my in-house specialist on triple net lease properties. So we're going to do a deep dive on how they work and what the ins and outs of those are, and also how to build a portfolio with other properties included with that triple net lease property. And we generally get a blended portfolio return of around 8%. And so again, we'll be walking through how to diversify your portfolio and all that on Thursday. So thank you all for listening in. I really appreciate it. Everybody keep your distance and stay healthy.